Hi, everyone. Welcome, and thank you for joining us today. I'm Rupi Chima. I'm the managing partner of EB5 Energy. And today I'm joined by part of our stellar team. I'm joined by Mark Wagner, our CEO, Mike Shord, our geologist, Dennis Tatum, our CFO, and our drilling partner, Kyle Messi. They will talk more about the project and operations and their background a little bit later in the presentation. And I'll talk about the EB5 aspects of the project. So before we get started, in case you don't know, we are an oil and gas drilling project in the state of Oklahoma. We are not an oil exploration program. We are a recompletion program. We are drilling in proven reserve. We're using modern technology to increase production 3 to 5 times more than what was originally produced out of these wells. Before I go on with my presentation, I like to play about a 4-minute video, which is our process of how these wells are drilled.
Vertical wells drilled during the 70s, 80s, and 90s only extracted about 3 to 5% of total reserves available in their target area. The common misconception is that drilling an oil well taps into a pool of oil. In reality, oil and gas is dispersed throughout various layers of rock and migrate to the most porous areas. These areas are under enormous pressure from the weight of the earth above and dense rock below. By drilling a well, you create a low-pressure area, causing the oil and gas to be pushed towards the well. We'll be horizontally fracking previously drilled wells. This begins with drilling a 1.5-kilometer horizontal well from the existing vertical at a depth determined by our geologist. A perforating gun is then inserted. Creating foot-long fissures in the rock formation. Fracking fluid is then pumped into the well at extremely high pressure, cracking the shale rock and creating fractures where trapped oil and gas escape. Sand and clay is injected to prop open the fissures. Newly fracked wells are initially expected to generate about 300 barrels of oil per day, then decline to about 100 barrels of oil per day by the start of year 2. Our focus is on the Mississippi Line, a geological limestone formation rich in calcium carbonate that was formed through the deposition of organic material. The formation is approximately 100 meters thick and is renowned for its abundant oil and natural gas reserve. By fracking this horizon, we can extract 15-30% of the existing oil and gas resources compared to just 3 to 5% from the original vertical well. And utilizing the existing vertical well reduces costs to just $27 per barrel of oil compared to $35 for newly drilled wells. With existing surface equipment already in place, we can start producing oil immediately after completing the fracking process. Due to high oil and gas activity in Oklahoma, existing gas pipelines and oil chains are readily available for transports from our site. Our success in recompleting vertical oil wells relies on the expertise of our oil and gas team, which includes a geologist, a petroleum engineer, drilling engineer, heavy equipment operators, and field service technicians. Their combined knowledge and skills ensure that we identify the best opportunities and implement effective techniques for unlocking these untapped reserves. Invest in America's energy independence with EB5 Energy.
We are a rural project and we have been approved by USCIS. So our Form 956F has been approved. And we also have 2 investors who have received their I-526E approval as well. Rural project gives you priority processing of your petition, and you also benefit from a 20% visa set aside. So we're expecting I-526E approvals now between 6 and 8 months. And we are approved for up to 150 investors, $120 million. But we are right now starting with phase 1, which is we're focused on first 8 wells right now, which requires 25 investors. And on the financial side of things, this is not your typical loan model that you're used to seeing in EB5. This is an ownership model, meaning EB5 investors invest into the new commercial enterprise, or what we call the EB5 fund, which owns and controls the project entity, which owns all the production. We are structured to repay investors after 3 years. During those 3 years, we have a 9% dividend pool that the job creating entity pays to the new commercial enterprise to pay its costs, such as fund administration cost, broker fees, regional center fees. So out of that 9%, whatever is remaining, EB5 investors are entitled to half of that. So we're estimating that in the first 3 years, EB5 investors may receive anywhere from 0.75% to 2.25% annual yield. They receive that while their capital is deployed, then they get paid back at the end of 3 years. And at that point, we do not liquidate your interest. You stay in the company as limited partners as long as the company is operating. These wells will produce for an average of 20 years. So after you get your capital back, then the EB5 investors collectively participate in 35% of the profits of the company. The project is in the Anadarko Basin in western Oklahoma, one of the world's richest hydrocarbon regions. Our company controls 1,280 acres of proven producing leases. This project is operated by Spire Asset Management. They have drilled over 2,000 wells in the area, and we're located very close to Cushing, Oklahoma, which is a major storage and pipeline hub. I want to tell you a little bit about how this project came about, because as most of you probably know, that EB5 has essentially for the last 2 decades been a real estate financing program. You don't really see many other industries using this program to raise funds. I've been in the industry since about 2012, doing due diligence on projects. I had the opportunity to look at hundreds of offerings, and I didn't always love the structure of these offerings. I felt like there was a lot of room for developers to take advantage of investors. And a lot of times the investors didn't really understand the structural risks. When the rules changed in 2022, I saw an opportunity because the new rules provided 2 huge benefits to investors. One was that if you invest in rural projects, you get priority processing of your application. And the second one being they clarified how long you have to keep your money invested. So USCIS basically said you only have to keep your money invested for 2 years. And to me, large real estate projects that have 3-4 year construction timeline and a couple of years of stabilization really didn't fit that mold anymore. To me, oil and gas really was perfect to deliver on both of these benefits, one being rural, the second being a quick generation of cash flow so people can be paid quickly, as opposed to in real estate, you really typically need 5-7 years before you can see a refinance scenario or any kind of an exit scenario for your funds. So that's how this project came about. I saw an opportunity to offer investors a fair deal, a fair shake. And so I'm very excited about what we have created here. Just to give you a little bit of a highlight on a well-by-well basis, as I mentioned earlier, a well would typically produce for about 20 years. If you see from this chart, though, a lot of its production comes in the first 3 years. It produces at a declining curve. Whereas any other business that you invest in, you have a big capital investment in the first couple of years, and then you slowly start reaping the reward. You slowly build up. It's typically the opposite of what we're seeing here. We're expecting an oil well to produce 250,000 barrels over its lifetime. But about 50% of that is going to come out of the ground in the first 3 years. So that is what gives us the confidence to repay the investors after 3 years. I've already talked about some of the waterfall. There will be some yield in the first 3 years, and then there will be profit participation after you get your money back. And we have great oversight and governance over the program. One is I'm a CPA. I really believe in internal controls and dual control. Customers Bank is our escrow agent. So the funds would come into Customers Bank. They get released into the EB5 fund once the application has been received by USCIS, and we have proof of that. And then Trident Trust is a third-party fund administrator. They're a co-signer on our EB5 fund account. So when we need to move the funds from the new commercial enterprise or EB5 fund into the project, Trident Trust has to sign off on that. And then once we deploy the funds into the project, 30 days after that, Spire, as the operator, gives them a report of how these funds were spent. So we have complete transparency over how the funds are being moved around and how the funds are being used. We're sponsored by Mid-America Regional Center, which ensures the immigration compliance and job tracking and reports to USCIS on an annual basis. And Mid-America is sponsoring a couple of other very large projects right now. It's an ownership structure versus a loan model. Typical real estate projects that most of you are looking at are in the business of lending money. You make an investment into a new commercial enterprise, which is making a loan to a project where the developer owns the project. We are an equity ownership. So the EB5 investors are shareholders of the company, which means they have control over the assets of the company. And typically the exit scenario for real estate projects, as I said, is 6-7 years down the line from refinancing scenarios. So obviously it introduces a long timeline. It introduces a lot of risk. You don't know what's going to happen in the future, how market's going to shift. And depending on how much debt you're carrying on that project, there can be refinancing risk. For us, it's a very simple exit on your money. We basically sell our product and we pay the investors back. And another big advantage with our equity model is that our interests are aligned. For example, when you lend your money to another person, you're really just dependent on them to pay you back. So then it comes down to what kind of remedies you have available, what kind of security you have available to get that money back. Now, EB5 investments are typically not a first lien loans. They're not secured loans. They're unsecured loans, structurally subordinated, and where the investor's getting maybe 0.5%, 1%. So the risk you're taking with that subordinated loan is not at all built into what you're getting. And if there's default, the remedies may be non-existent, right? Let's say the project falls into trouble. The bank, which has lien on all the assets, is going to take over, and there may be nothing left for investors. And also, pursuing default is very costly. It's costly and time-consuming. And in the end, investors end up walking away if there is default. Whereas with us, the equity owners own the project and own the production and own the assets, and they're first in line to get repaid. Our cash is restricted structurally. We cannot take profits until the EB5 investors are repaid. So the return of investment is first in line. Why EB5 Energy? It's USCIS-approved, so our project denial risk is completely mitigated. And I believe that it's a better model. It's an ownership model versus a loan model. Investors have first priority on cash flow. The production risk is low because we're drilling in proven reserves. We have independent oversight over all our fund transfers, so you can feel safe about that. And one of the things our CFO is going to talk about is tax benefits. There is real tax benefits available to investors that can offset your passive income. And ultimately, As management and operators, our interests are completely aligned with yours. We participate in profits once we execute on the business plan successfully, pay you your investment back. Then we get to participate in profits alongside the investors. So we're completely aligned with you, as opposed to being a friction between a lender and a borrower. So at this point, I'm going to turn it over to Mark.
Thank you, Ruby. This is a deeper dive into the program itself, more specifics about what we're going to do on a technical basis, who the team is, and why we believe that we can do this and generate assured revenues and production. The team that comprises the executive group is Rupi Chima. Myself, I have 45 years of oil and gas experience and have drilled over 2,000 wells globally and hundreds in the Midwest and probably 50 or so in Oklahoma in my career. Dennis Tatum, he's a 35-year CFO in oil and gas. Eric Marshall, who could join us tonight, has over 22 years of completion and reservoir experience. And Michael Shorter, geologist, has a year up on me. He has 46 years of experience and about 5,000 wells. Our key staff includes Eric Cunningham. He's an advisor for geology and operations. He has 40 years of experience. I most recently worked with Eric over in drilling and production optimization program in Russia. Brent Justice, our petroleum landman and in charge of our land and leasing, has 20 years of landman experience. Here's Oklahoma. And the county that hosts our program is Major County. It's roughly located right here in Oklahoma. The area that we'll be operating in is roughly 2 hours from two of the major oil and gas headquarter hubs in Oklahoma, Tulsa and Oklahoma City. I want to talk a bit about the infrastructure for oil and gas. Here in the United States, this is Oklahoma here. There's an extensive system of natural gas and oil pipelines that allow us to sell and move our crude oil and natural gas production. So just to locate ourselves again, here's Major County in Tulsa, Oklahoma. This is a map of the oil lines in the United States, and these are the major oil lines. There are numerous sublines that reach out from some of these larger lines. This is the natural gas pipeline network in the United States. Natural gas is more readily distributed and collected through the United States than oil. And when you put them all together, they look like this, and that's quite a jumble. So I thought I'd point out Major County one more time. You can see we're in a hub of infrastructure. It's not an issue to move oil. It's not an issue to move gas. We're just surrounded by infrastructure. Let's dive in a little bit closer to where we are in Major County. This is what we would call an oil depot or a collection terminal very close to our location. So trucking our crude oil to this location, which is so close, brings the cost down. And you can see the oil distribution from there moves all around to refineries in the United States. A quick overview on geology. This is a cross-section of the earth sliced this way through Oklahoma and southern Kansas. This is what we call the Anadarko Basin here. And it's shallower to the north and northeast. It gets deeper to the south and southwest, which is what this cross-section shows. So our project has been selected in the shallower depths for two reasons. One, is very productive, but also it reduces the drilling and completion risks by being shallower. If we're down here in these areas and these counties here, we would be drilling at twice the depth. And that's one of the reasons we selected this area as our focus area. Mike, if you'd like to talk a little bit more about our position here in Major County and the offset wells that we've looked at to put our position together.
Sure, thank you. So you see the two yellow boxes, that is the acres that we control right now. It adds up to 1,280 acres. That's two sections of 640 acres each. So every square on this map is 640 acres. That's 1 square mile.
Mike, you looked at most of these wells around here. There's a lot of public information here, isn't there?
There's a lot of public for production information because it all has to be reported back to the state. So we know where they drilled these wells almost exactly because you have to file a directional survey. So we know where these wells went within the Mississippi line. Now, logs, high-tech data, we don't do that anymore in horizontal wells, or very seldom do we do it. because we know this reservoir very well. We know most of the reservoirs out here very well.
And Mike, would that be because of the vertical wells, the population of vertical wells that we show here?
Right.
Here's our position here. Yeah.
Correct. So there's over 200,000 vertical wells in just this area of Oklahoma. The green dots are oil wells. The red is natural gas. And we're looking at Major County. There's a white box surrounding, and there's the same box in green now. And this map has only the horizontal wells that have been drilled. Remember, horizontal technology has only been around for, 20 years at the most?
15 to 20 where it's really taken off.
Yeah.
Yep.
So this has all happened for the past 15 years. So every little stick that you see on there is a horizontal well. Most of them go 5,000 feet. Some of them have gone 10,000 feet.
So you can see our two sections right here, our Weaver unit and our Schrader unit here, right? Those are each 1 square mile. It gives an idea of the scope, the size of these.
Right. Quite a big area. And this is all Mississippi line production. All those wells, the horizontal wells, were Mississippi line wells. So I put this together. You go in with the vertical wells. We have data that we can go in and map it and do some petrophysics on it. And we come up with a net payment. That's how much reservoir there is. And it varies across the Mississippi here from 225 to 500 feet thick. We have different nomenclature for the Mississippi line. I say it's 600 feet thick, but where we're really concentrating is about a 300-foot interval in the lower portion. So this is a bigger map of looking at the total Mississippi line bay. And the big black oval is a very large area. It's 900 square miles, 580,000 acres. And you can see our two little 1,280 acres sitting in there. And then the canvas wells in green. That's what we reference everything back to.
Mike, can we also point out that we'll be drilling 4 wells in each of that area?
Correct. So what you see here is green and red bubbles. It's representing oil production. Remember, these wells are still producing. This is as of probably 2 or 3 months ago. So the bigger the green, that is the more oil. There's a limit to the size. I had to limit it or it just takes up the whole land. The gas bubbles, the biggest ones, there's 2 of them on here. One's right next door to our acreage. Correct. That's an Exxon well. We'll talk about that for a little bit. But that's up to 2.2 BCF. So these are good wells.
Mike, this is cumulative production, right? So this is production to date. This is section 8. Mike, why don't you describe a bit about how we're going to drill? This would be the pad and the location of our horizontal laterals in that section.
So that's 640 acres that you see in yellow. And we are going to build a pad to drill all 4 wells just south of section 8. And we can drill these wells fairly easy. And that's what the red sticks are showing, where these wells will actually traverse. The true path of the wells are these little black lines that are following it. We've had directional companies do all this work for us and tell us, yes, you can achieve this with no problem. We do it every day. So the first we plan on drilling is the solid red one. It's called the P. Weaver number 2H. And after that, we have a permit to drill the P. Weaver 1H. Both of these are in hand, and we're ready to drill.
And Mike, how long does it take? Let's walk through very quickly. We put units together, which means we've tied all the individual mineral owners in section 8 together into a pool, called a unit. And now that unit allows for us to break out these individual drilling spacing units. So we have 4 of those. And that's all been work we've done over the last 6 to 7 months with the Oklahoma Corporate Commission, the oil and gas.
Correct. It's a tedious process. Remember, the state of Oklahoma or the United States doesn't own any of this production out here. It is individually owned by the landowner, the mineral owner mostly, which has been segregated over time from the landowner to the mineral owner. So there's a lot of different mineral owners, and they get
and the point,
generations. So
the point I was trying to make, Mike, was that we have 2, but now that we're teed up, it's a matter of just filing our application and getting it approved for additional wells. Is correct? So there's really no time lag anymore.
no, we could have those permits in 10 days.
Okay.
The other 2 permits. because everything's been done. All the groundwork has been done, all this to create a 640-acre unit to where we can drill these wells pretty much anywhere we want to.
Here's the Schrader locations, Mike, and this is a similar story, right? The only difference here is we
Correct.
decided we're going to sidetrack an existing Schrader number 2, and we're going to drill a hook in here. The other
Correct.
well, new drilled right next door, and it'll go like this. And these are called drilling pads, and we'll have 2 drilling pads for section 20. Pad will be drilled here with the production facilities for these 2 wells, and then this pad will be built for 1 sidetrack and 1 brand new. And those are all in process as well, Mike, so the permitting process and timing is the same.
Correct. If you see on here the green dots that are on the map also, all of those are Mississippi line wells. Most of them are not producing anymore because they're old. They've been around a long time. So if you notice the first slide on Ruby's presentation, you only get between 3 and 5% of the oil out of a vertical. That's why you want to go drill in between all these wells, because there's a lot of oil left.
Great. Mike, you want to talk just briefly
Right.
about this Exxon, and then we can move on to
Exxon drilled 2 horizontals off the same surface location. One went to the north, one went to the south. This was in 2019. And you can see the southern well is mostly oil with some gas. The northern one is mostly gas with a bunch of oil also. So they're great wells in the Mississippi line. And that well, do you have it on? Yeah, 624 feet away from our southwest corner.
And the geology is so assured. It's so common across here.
Correct. We have
And that's-
so much well control out here for the past 100 years, really. They've been drilling wells. But
Thanks,
those are
Mike.
2 phenomenal Mississippi line wells. They're still producing. They've been on for 6 years now, to over 200,000 barrels and 2 BCF. And I don't know what the EUR, the ultimate recoverable on those wells, but it's going to be probably over 300,000 barrels.
This one to the south, the oil producers,
It's already at 300,000, but
they probably make 450 to 500,000.
probably it could be 500. Yeah.
Okay.
So
Well,
that's
thanks,
what
Mike.
but these are 10,000 foot laterals. The 5,000 we want to drill.
Yeah, that's right. That's right. But
It
still,
doesn't
they
double the
represent-
amount of production, but it helps. But you can see in the Canvas Energy, a lot of those are the 5,000 foot wells, and they're very good. Bubbles right there. Those are all 5,000 foot wells. All right.
Thanks, Mike. I want to talk a bit about risk mitigation and how Spire is addressing the risks associated. We just talked about the geological risks associated with what we do, and we're drilling wells where the offsets were successful. So we just talked about successful production and successful wells drilled by offset operators. Because the knowledge is extensive and the reservoir is so consistent across the county, the reservoir quality is well known. Our drilling costs are kept low because our total true vertical depth, that's the depth from the surface down to the reservoir, that's just the depth from the surface to the Mississippi line, of 7,100 feet, is low to mid in terms of what the industry considers a deep well. It's actually a relatively shallow well. Right, a 1 mile lateral is relatively short. Those were selected because they lower the risks of drilling and completing the well. Operating costs, which we call OPEX, a big component is water disposal. We have negotiated with a commercial saltwater disposal well to pipe our water to them, which lowers the cost from about $2 a barrel to about 60 cents a barrel. So we have $1.30 per barrel of water reduction since the water doesn't have to be trucked to disposal. And that's meaningful because the well will probably come on at between 1,000 and 2,000 barrels of water a day initially as it cleans up the stimulation fluids and drop down to 300, 400, 500 barrels of water a day over time. And our superior contractors, we've selected drilling service companies with tremendous experience in the area, and we're only as good as our service partners, of course. And we have an established relationship with the Oklahoma Corporate Commission and the regulatory agencies that guide what we do, and that minimizes the risk of any sort of errors that we might make from a regulatory standpoint, and make sure that what we do is commercially acceptable and viable to the regulatory agencies in Oklahoma. Some of our key partners: Next Tier Hydraulic Fracturing, Stamper Drilling, MS Directional, and Stellar Drilling Fluids. These are the companies that provide most of the key services, especially the drilling company. Once the well is drilled using a directional drilling company that provides the tools that allow us to directionally drill the well and then drill the horizontal section of the well is done, we frack the well with a company called Next Tier. Stamper Drilling is an interesting company, and joining us today to talk a bit about his experience in the area is a gentleman named Kyle Massey. Hey, Kyle, thanks for joining. Kyle, you have quite a background in this area. Why don't you tell us a bit more about your background?
All right. Prior to being one of the founding members of Stamper, I was a member of a couple of different E&P organizations that drilled in the mid-continent, specifically in the area that you're targeting now. I spent a number of years at EB5 Energy, which is one of the larger independent oil and gas companies in the U.S., working in their Western Anadarko Basin, drilling and completing wells. And then I was part of a group called Red Bluff Resources, where I ran all of our operations, drilling, completions, and production, specifically drilling in Kingfisher and Major County. We ended up operating over 250 wells surrounding the area that you are. And as it turns out, Stamper has drilled several wells in Major County for our second line acquirer, and continues to operate in Major County and the surrounding counties of Western Oklahoma.
Kyle, what would your role be in helping us out through Stamper?
So we will have our personnel on site every day, in addition to the Spire personnel, bringing local knowledge that has been on the ground in Major County for years and years to this point, and just helping bring best practices forward and things that we've seen be successful for other operators close by. And these are benign wells as far as drilling and completions go, especially for the Anadarko Basin. The Major County is shallow. It's normally pressured. You don't see a lot of the issues in other parts of the state. So there are just a few things from an efficiency standpoint we would like to help with, and we'll be intimately involved in. By and large, with the experience that you're bringing to bear and how benign the drilling and completion environment is in Major County, we don't expect those to be extraordinarily expensive or be very long to drill.
Yeah, Kyle, I'd like to mention too, and put it in context for some of our attendees, that similarly to real estate construction, where the developer relies on key service providers for materials and services, carpenters, plumbers, roofers. In the oil and gas industry, we have key providers as well. And the drilling company, as I said before, is a major provider of services to us. But given your background in E&P and now the ongoing learnings that Stamper gets from working with other smaller and major companies in the area, what you're saying is that you'll help bring some of that knowledge and information to what we do as we drill our wells. Is that fair to say?
Absolutely. And as we have been in the months preceding now and through the project delivery, continue to help with your plan to every step that we can, and recommending anything that we see that can be improved or other improvements that operators in the area that are actively drilling have seen. And we'll be there every step of it as we go through this process.
We're really blessed to have some great players out here, especially at Stamper. Kyle has been a resource for us over the last few months to help us dial in what his rig costs will be, what he knows might be any sort of issues that we'll have drilling the well, how to avoid those, how to mitigate that. We also have an established relationship with Stellar Drilling Fluids. They provide the fluids that clean the well as we drill it and provide wellbore stabilization, which is very important. We've also worked extensively with the directional drilling company to plan our wells and lay them out. And they've drilled hundreds of wells in the area and is constantly fracking wells in the area. So these are our key partners. And I think by selecting these kind of partners, establishing the kind of relationship that we have with Kyle, does as best as we can, as best as I think anyone could do, to lower the risks associated with drilling these wells. Kyle, do you have anything else to add?
Well, we're excited for the project to start. It's a fun area to be in, and we're happy to be a part of it.
Appreciate you. Thank you, Kyle.
Thanks, Kyle.
Thank you.
I'd like to talk just for a few minutes about economics. The single well economics of our wells is presented here. I've got 3 cases that are varied by the oil price. We have what we consider a low oil price of $45, expected oil price of $60, and a high oil price of $70. We kept the gas price to not create too much complexity here. We kept the gas price at $2.50 per 1,000 standard cubic feet of gas. At these numbers, our expected oil revenue generated is between $9.5 and $14.7 million. The gas revenues stay the same because the gas price is the same. The total revenue would be the sum of oil and gas. So we have about 12.1, a little over 15 million for our expected case, and total revenue for our high case is $17.3 million. Our net, which is the total revenue minus operating costs that you see here at 4.17 and almost $9 million. The rate of return on our project on the low case is about 20%. Our expected case rate of return is 40%. And should we achieve either through hedging or through actual oil prices, a $70 per barrel price, we'll generate somewhere around 56% internal rate of return on the expended capital of $4.5 million. The return on investment is a multiple of 1.9 on our low case, up to almost 3 times on our high case. And I think importantly to everyone who would be an investor and a partner in a project, how long does it take to get our invested capital back? And on the low case, it's almost 4 years, expected cases. And then on the high case, it could be as quickly as 2 years. I didn't put a production curve in here. You had one notionally in your slide that showed that the well comes on initially high and declines. Our case is based on 300 barrels per day of initial production and about 1.1 million cubic feet of gas a day, and it declines. And these economics are the result of that production decline curve that we put together.
Mark, you might want to talk a little bit about hedging. What would be the plan for hedging?
We would hedge 75% of our production at a price around $60 or $65. Once we lock that in, we would have that percentage of production locked in, and we would hedge our natural gas production as well. It's at $3 now.
Great. Dennis is our CFO. He's going to talk a little bit about the tax benefits that are available by investing in oil and gas. That could be very valuable to some of you if you have passive income.
This is Dennis Taterman, CFO for the company, and I put together a pro forma example. And I want to focus on the net interest. So on the far right-hand side is basically what an $800,000 investment would do if invested into a single well. So when you drill a well, you got 2 components of costs. You got the intangible drilling costs, which is typically 60 to 80% of the well. And intangible costs are the cost of the drilling rig, drilling fluids, fracking, and all that kind of stuff. And the remainder would be tangible drilling costs, which is basically your pump jack and your flow lines and your tanks that you got to use to get the oil and gas out of the ground and sell it. Tangible drilling costs are 100% deductible as they are incurred. So it's a 1-for-1 deduction. The tangible drilling costs are amortized over 7 years. So you get to fully deduct your investment. In the U.S., we have tax preference items for the oil and gas industry. And the biggest percentage depletion deduction, it's been around for 30, 40 years. It's not ever going to go away. Basically, this deduction is you get 15% deduction of your gross revenue. When I say gross revenue, that's your sales price. So when you look at the table, you can invest $800,000, deduct your investment, and get additional tax preference items of $400,000 for depletion over the well, which would give you a total $1.2 million in deductions. So you get almost 50% more deductions because of the tax preference item, which is a really good deal. That's one of the reasons why the oil and gas industry in the U.S. has been successful. But there are a couple other considerations that we talk about because our structure is an LLC. And in an LLC, you get passive income treatment to all passive losses. But the good thing about that is that passive loss can be carried forward indefinitely. So that's a brief overview of the oil and gas taxation works that we have in the U.S. And it's very advantageous to invest in an oil and gas project tax-wise in the U.S.
It would be fair to say that none of these benefits are included in the economics I showed, correct? These are just
These are extra.
additional tax benefits. Is that right?
Well, all your economic runs are run pre-tax. This would be an LLC. Taxable income flows down to the individual investors to what we call K1s.
Exactly. So these gets reported on your annual K1. I do want to say We are not providing tax advice here. So this is just to give you a general overview of the benefits that are available. So you would have to consult your own tax advisor. Because you're limited partners, these are only available to be applied against passive income, meaning something that you're not actively involved in. So you cannot deduct from a salary income or business income that you're actively involved in. But if you suppose you had some rental income, dividends, any passive activity, these can be applied towards.
Thank you, Dennis. I want to show you a few of our more recent field operations. This is a workover rig working just to the west of our area here. We're pulling tubing out of the ground. We're preparing to do a workover on this. This is one of our derrick men up in the derrick. This is one of our pump jacks pumping oil and gas. This is a beam pumping unit. There are about 5 different kinds of what we call artificial lift in the oil and gas industry. The most predominant one is a rod pumped well through a beam pumping unit that's shown here. And this is our Hulk number 5 production facility. These are 2 oil tanks. These are 300-barrel oil tanks and a 210-barrel water tank. Oil and gas would flow into this separator, which would produce gas out of the top of it, and the liquids would go into this treater here, which would then separate the oil and water and move the oil into the tanks with the yellow stripes and the water into this tank here. Natural gas would come off of this, move through the meter, which is right here. And the meter, it's owned and operated by the gas purchasing company, and that's the basis for our revenue checks from the natural gas sales. This is a recent frac operation. This is one of the relatively smaller ones we've done. We only have 3 pump trucks and a frac sand handler here. This job went on for several days. When we start fracking these wells, we go through the night. We'll go between 18 and 20 hours a day of pumping time to get the entire lateral fracked. The water that we use is stored in what we call frac tanks. Each one of these tanks holds 500 barrels of water that's going to be pumped into the wellbore. This transfer pump moves it from these tanks through this manifolding system and off to these hydraulic pumping units. This is the installation of a pump jack on one of the producing wells. We usually use a crate. It's a pretty large pump jack. It takes us about 2 days to set these pumping units up. This is the Weaver pad, and the 4 wells that Michael described earlier are represented by these green lines here. The saltwater disposal is right here. We've negotiated that low disposal price, so we'll install this. It's just about a mile. It'll probably be a 6-inch diameter line to move the water along here. We have established contractual agreements with the landowners to put the line in. That's all in place. The same with the surface use agreement with the landowner here has been negotiated and is under contract. So we have all of our contracts in place to begin to drill, with the exception of some of the key vendors. And we've been waiting on that because normally a price quote from someone like Stamper, they would like to not go further than 30 or 60 days out for their pricing. So we should be starting to dial in the quote for the drilling rig, the directional and drilling fluids here in the next month or so.
Mark, can we talk a little bit about proven reserves, how we have some wells that are dripping, that are producing at a nominal level, and that we have contracts to sell oil and gas, and we have been selling some production?
We do. So in section 8, which would be the first area we drilled, the Pauline Weaver number 2 right here is producing about 2 barrels a day and roughly 20,000 standard cubic feet a day of gas. And down here is our Weaver number 1 that's producing about a barrel of oil a day. So we have these 2 producing wells in section 8. Over in section 20, we have the Schrader number 1, which is right here. That's producing about a barrel a day. And we have the Hulk number 5, which is right here. It's averaging about 4 barrels of oil a day. And they both make natural gas. This makes about 5,000 standard cubic feet per day. And the Hulk's making about between 10 and 15,000 standard cubic feet a day of gas.
And can you talk about who we sell this to and just a little bit of the sales process?
Yeah, we sell the oil right now to Energy Transfer, which is a large oil and gas purchaser. We're going to move the contract. We got a more favorable contract with CP Energy. They're another large crude buyer in the area. The natural gas was being sold to a division of ExxonMobil called XTO. That was purchased by Mach Natural Resources, another large public company, and that's owned and operated by Mach Midstream. So all that is being currently sold to those 2 companies.
Great. There's one question. When will the first well be drilled to start production? Will you start drilling even before EB5 Capital enters the project to kickstart production? No, we're waiting on a couple of investors. We have about 12 spots spoken for. So we're expecting wires in the next 45 days or so, and that's when we expect to kickstart the whole process. How many investors have subscribed already? Since when is the project open for subscription? So as I said, we have about 12 investors that have committed. 4 have wired. Out of those 4 that wired, 2 have gotten approved, and 2 are wiring next week, and they're ready to file. So that's 6, and there's 6 right behind it. We did get our approval in September of 2024. We have been marketing the project for a while, before September 2024. Because it's such a unique product, it's taken a while for people to warm up to oil and gas and learn more about it. Once we got our project approval, and now once we got our I-526E approval, now it's really picking up steam. People are getting confident on the immigration side of things, and also learning more about what a great project it is. Somebody's asking for a phone number. I will answer that privately. I guess we will end it here, and we really appreciate you joining us. If you have any questions, please feel free to reach out. And thank you, Mike, and thank you, Mark, and thank you, Dennis.
You're very welcome.
Thank you, Rippy.
Thank you.
All right, bye-bye.